What's going on, guys? Welcome back to another video. So in this one, I like to call this the ultimate guide to risk management. This video right here is going to really help you guys tighten up your risk on a lot of your trades. And if you combine that with the stop loss strategy that I've shown you guys in a lot of other videos and live streams, it enables you to keep your losses smaller and really fully capitalize on the larger wins that you're going to have due to the method that you're using for trading. Now, again, this is going to be easier said than done and is going to require a lot of discipline in order for you to do so, but we're going to walk you guys through every step of the way. So again, before we get into all of that information, everybody, if you do enjoy the information and analysis that I do provide for you guys in these videos, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who actually want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. And again, just a quick reminder, our brand new platform has just went live with all of our predictive algorithms, unusual options activity, all of the alerts, the live streams, the curriculum videos, the compounding interest calculators with all of the schedules that you need. Again, guys, if you want to get access to this completely for free for 21 days, make sure you guys check out that link down below. But again, this is only going to be lasting until the end of December, and then the free trial period goes to 2 weeks. But let's get right into it here and talk exactly about what we need to in terms of risk management. So I have a couple of notes here for you guys, and you guys have really heard me say this a lot, that in terms of risk management in trading in general, it all comes down to what I like to call the 3 M's: the method, your mindset, money management. Now, when we refer to mindset, it's not like what you see on the internet all the time of, oh my God, you need to have this sort of mindset. When we refer to mindset when it comes to trading, it has to do with emotional psychology and intelligence, which also feeds into money management or risk management as well. But the first thing that you need when you are going to start trading in order to be able to manage your risk is some sort of method that you're trading with. Now, for us, it's going to be the core of the 1348 crossover. Again, we have those predictive algorithms that are absolutely amazing on all those different time frames, but the core is going to be these crosses, and you are going to need to have some rules when you are trading above or below the 200 EMA. You need to know exactly where these key levels are, and then it gets into mindset and money management. So knowing how you specifically react to having money at risk in the market is an incredibly powerful thing, but you have to have almost enough emotional intelligence to really take a step back and realize how you are reacting when you have money at risk. Let's just say, for example, that you are going to set a 10% stop loss on a position. You say if the position goes down 10%, I'm going to sell. It then ends up going down 10%. What do? Do you sell it or do you hold on hoping that it's going to come back? Those are a couple of things that you need to identify. And then money management as well. Again, with all of the things that we're teaching with 1348, there's going to be a 5 to 10% portfolio allocation per trade, and we are usually aiming for base hits. Now, again, follow your plan. There is no room for hope in this game. In order to be a successful trader, what you need to do is become a really, really good loser. You have to understand, either on the chart or with your stop losses, when a trade is just not going to go in your favor. Nobody has a 100% success rate. Nobody is winning every single one of their trades. But in order to have success, you need to understand when your trades are not going to go in your favor, which we are going to go over as well. And there's really 2 main ways to manage risk. The first is going to be a hard percentage stop loss. Whether or not you're actually setting this stop loss out when you enter the trade, or if you're going to do more of a mental stop loss and watch your position, this is going to be the first one. You say, hey, if the trade goes down X percentage, usually that's going to be around 10 to 15%, that I'm going to exit the trade and move on to the next one. But again, if that's your plan, you have to be incredibly disciplined every single time that you see those trades go against you, and make sure that you're taking yourself out. Now, again, in order to manage risk a little bit better, we talk about getting more time on your contracts as well, but we talked about that in a lot of other videos. What I really want to go over with you guys in this video here is the second way to manage risk. And what it really does is it tightens and it really sharpens kind of the levels that you're looking at in order to know when your trade is no longer valid. The second is using a spot on the chart or a zone on the chart to determine that your trade idea is no longer valid. Now, how do we do this? Well, the first way is going to be utilizing key levels. Now, on the charts that we give you guys in our community and on our platform, all of these levels are already drawn out for you guys. So what you can do is extend them on your chart. You can say if price then crosses below a certain level, I'm going to enter puts. And if you see a 5-minute candle close back above, well, then the trade is no longer valid. Now, the second way, and this is the way that I use this the most, is to use these EMAs, the 13, the 48, and the 200. Now, I want to go over a couple of examples of this, and we're actually going to go through some chart replays over here to make sure that you guys can fully understand exactly what I'm looking at. So the first is going to be the NVIDIA chart from, let's see, this was Thursday, December 8th. Now, I'm going to play this here and we're going to slowly walk through what's happening at market open. So as we can see here, this is going to take a couple of seconds. I've slowed this down a little bit, but you can see that coming into market open, you see NVIDIA kind of flashing around here. Now, as we start to get into market open over here, you see a pretty significant red candle. It ends up popping back up off of the 200 here and then ends up selling off through and also gets a closing candle down below and a put signal. Now, I want to pause the chart right here. At this point right here, you see that price is just sitting right around this 200 EMA, and it looks like out of the gate, 5, 10, 15, 20 minutes into the trading day, that NVIDIA does look like it wants to come down. Now, what you could do in this situation is if you were just taking a look at this chart right here, you could say, well, I'm going to enter these NVIDIA puts with enough time on these contracts here, and I want to be able to make sure that I'm going to be able to take myself out at either a 10 or 15% loss. Now, that's perfectly fine. You just have to make sure you're winning around 15% of your trades and your wins are bigger than your losses. But the second thing that you can do is say, well, I'm looking at this breakdown, a retest, and hopefully a rejection of this 200 EMA. If you see price go above this 200 EMA, closes above, that is then where you want to be getting out. Now, the reason for this is it's going to keep your stop loss super, super, super tight. Now, rather than taking the 10 or 15% loss, by using it this way, you may only be taking a 3 or 5% loss on that trade, meaning that if you then go and hit another base hit of 10% or 15% when a trade goes in your favor, you're relatively green on the day. So let's continue this chart right here and see exactly what ends up happening, because this is a really good example of what can possibly happen to some of these trades. So you see NVIDIA, let's see right here, it ends up coming up, tests the 13 and gets a candle close above the 200 right here and starts heading higher. At this point, somewhere on the body of this candle, this would be a good spot to exit. Now, if you're waiting for that 10 or 15% stop loss, well, if we continue playing this chart, it 100% is going to get hit. As we continue and we see what happens to these candles, you see that NVIDIA ends up going on a pretty meteoric moon mission. And if you were trying to play this retest of the 200 and breaking it down, it ends up shooting up, stops you out at 10 to 15% loss, and you have to move on to the next trade. But if you were using this 200 EMA as kind of your little line in the sand to say, okay, if price then stays below here, the trade is still valid. If price then closes back above, the trade is no longer valid. So now let's go over an example of something a little bit different, and this is actually going to be a trade that works. When we come over to Tesla over here, this is going to be Tuesday, December 13th, and I want to make sure that we understand these replays here, because it's going to be a little bit more difficult to see on the chart if you're looking at it when you can see all of the candles. I think these replay functions and replay tools are incredibly helpful to really give you a little bit more time on the charts. You guys can all do this too with TradingView. You just click the replay function, pick any spot on the chart, and you are good to go. But let's take a look at Tesla here. It's going to be a very similar situation to what we were looking at with NVIDIA, but let's see what happens as this trade starts to play out here. And let me see if I can get a pause exactly where I'm going to need it. So you start to see Tesla breaking down here. It ends up getting down below this 200 EMA in a second. I don't actually want to ruin all the fun here. Sorry. Oh, there's that candle right there. And then you see this. Now, again, you start to see price action coming to the downside here. Now, if this was normal price action after 10 and Invictus was alerting, you would see Invictus alerting this Tesla put. But what you see here is a closing candle down below the 200. You see it right here, comes back up, retests this 200. You don't get a candle close back above. And then you see what happens next, and price action just continues on its way lower, and you've hit a very successful trade. So hopefully you guys can see here exactly what we are looking at on the chart and really determining when these trades are going to be correct or incorrect. You can use a hard stop loss here. And as you can see, this Tesla trade really played out nicely. We were calling this out on the stream a few days ago here. And when you're looking at charts like this in terms of picking a spot and saying, this is my line in the sand, if price then closes back above this level, the trade is no longer valid, it keeps your stop loss super, super, super tight. And what it also allows you to do, if you're using the stop loss strategy and you're scaling out of these positions and moving your stops to break even or in profit, it enables you to further maximize the gains on the trades that play out very well. Going back over here, method. Sometimes the method is going to give you a trade that is going to play out beautifully, but it is up to you to manage your emotions and manage your money appropriately so that you are able to fully capitalize on these gains. So guys, that is really going to wrap up this video here on risk management. If you do have any other questions, make sure you guys leave them down below in the comments. But again, hit that like button on the way out. I'll see you in the next one. Peace.